The Federal Reserve, independence, and the debate over control. Trump's criticism of Federal Reserve Chairman Powell. Recent news highlights President Trump's criticism of Federal Reserve Chairman Jerome Powell over high interest rates. Discussions have emerged regarding whether Trump might attempt to fire Powell, reigniting debates over who should control monetary policy, an independent Federal Reserve or the federal government through Congress or the executive branch. This analysis addresses three central points: 1. The myth of Federal Reserve independence, 2. The dangers of placing the Fed under government control, and 3. Why the optimal solution is to abolish the Fed altogether. The myth of Federal Reserve independence. The Federal Reserve's claim to independence is a myth. Legally, the Fed operates under a dual mandate from Congress, to pursue maximum employment and price stability. This mandate was formalized in the Federal Reserve Reform Act of 1977. The Fed's operations must align with congressional directives, evidencing that the Fed ultimately serves the government's interests rather than functioning independently. Appointment and oversight of Fed leadership. The Board of Governors consists of 7 members nominated by the President and confirmed by the Senate. Thus, its leadership is directly shaped by elected officials. Additionally, while the Fed can generate profits, those profits are remitted to the U.S. Treasury by law. This financial relationship further evidences governmental oversight, contradicting claims of true independence. Understanding the Fed's so-called independence. When advocates assert the Fed's independence, they generally mean that it operates outside direct partisan influence, not outside governmental structure. It does not engage in activities such as electioneering. However, operationally and financially, it remains a government creature. Thus, by every substantial measure, the Fed is not independent. Risks of government control over the Federal Reserve. Calls to place the Fed directly under government control pose grave dangers. First, centralizing such power increases the likelihood of abuse. Separation of powers, a foundational principle of the U.S. Constitution, exists precisely to prevent the concentration of unchecked authority. The Fed's ability to create money and set interest rates affects every facet of the economy. Thus, such power must be decentralized to mitigate risks. The dangers of partisan influence. Second, if brought under Treasury or congressional control, monetary policy would become overtly partisan. Governments facing re-election could be tempted to manipulate monetary policy, such as lowering interest rates or increasing public spending, for short-term political gain, ultimately at the economy's expense. History and political theory both warn against vesting monetary powers in partisan actors. The real solution: ending the Federal Reserve. Rather than bringing the Fed under government control, the superior course of action is to abolish it. Central banks are a modern invention. The United States functioned without one until 1913. Historical data suggests that central banking has not prevented systemic economic collapses. Instead, it has exacerbated systemic risks by scaling local problems into nationwide crises. The history of economic instability. The establishment of the Federal Reserve did not eliminate depressions. It preceded the Great Depression of the 1930s, one of the worst economic collapses in history. Prior to the Fed, banking crises were typically localized and more manageable. Post-Fed, crises became national and global in scale, indicating that centralization magnifies, rather than mitigates, systemic risk. The economic illogic of price controls. Mainstream economists agree that price controls distort markets and lead to shortages, inefficiencies, and economic misallocations. Interest rates are the price of money, and monetary policy, the setting of interest rates and money supply, amounts to centralized price control. Allowing bureaucrats to dictate these factors undermines free market resource allocation and invites systemic failure. The consequences of centralized monetary policy. Controlling both the price and supply of money centralizes control over every market transaction, since money is on one side of every trade. Free markets function when price and supply are determined dynamically by participants. Centralized control of money distorts economic calculation, resulting in misallocations and boom-bust cycles. Political influence on monetary policy, a warning. Historical precedent shows that political pressure influences monetary policy. For example, President Trump pressured the Fed during the 2018 stock market decline, leading to a policy reversal and subsequent asset inflation. Such political influences threaten monetary stability, proving the dangers of partisan manipulation of the economy. Conclusion: decentralization as the path forward. Rather than folding the Fed into partisan institutions or retaining a deeply flawed system, the solution is to dismantle centralized monetary control altogether. Money's price, its interest rate, should emerge organically from free market interactions. Only decentralized monetary systems can safeguard against political manipulation, systemic risk, and economic distortion. Practical implications for investors. Investors must prepare for shifts in monetary policy. As political pressures mount and monetary easing looms, understanding market cycles becomes critical. Identifying undervalued assets requires analytical skills, not speculation. Resources tailored to bear market investing can offer strategic advantages as monetary shifts occur. The time to act is limited.